Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Tom Oviatt. Oviatt, excuse me.
That's
Oviatt.
Close enough.
Okay. Anyway, Tom is the Business Development Manager of Wymac Capital, Inc. And Wymac Capital is a mortgage brokerage company that works with financial professionals, including CPAs, enrolled agents, financial planners, and real estate agencies to originate loans with a variety of mortgage companies. Tom's been with Wymac for 6 years. Previously, he worked as a manufacturer's representative to consumer sales companies like Home Depot. So welcome, Tom. Thank you for
glad to be here, Mike.
Yeah. Well, today we're going to be talking about the current situation in the home mortgage marketplace. And by the way, this interview is taking place on December 1st, 2009. So just to give you an idea where we are. So right now, the stock market's sort of treading water, a little up, a little down, and the mortgage interest rates actually have been very favorable recently. So this is a great time in the mortgage business. After a really tough year. So anyway, so with that, Tom, why don't you give a brief recap about what's happened in the mortgage marketplace in the last couple of years?
Yeah, thanks, Mike. Yeah, you're absolutely right. 2008 was a tough year all around in the lending business. 2009 has been good for us all year long, and it's really been because the rates have been so favorable. Mm-hmm. It's been nice. We've just had a nice kind of steady flow of business all year long. But over the last couple of years, this whole lending industry has changed dramatically. You've seen it. We've gone from the point where just about anybody that was breathing could get a loan and could buy a house, to the point where I think most people in California now cannot get a loan. So the pendulum has swung dramatically. I remember, back in '07, we'd see people that were buying homes with no money down, and they were making payments, and people were advertising on the radio, hey, you can get a house payment for the same amount as a cell phone bill. So, I mean, it was crazy. People, and what real estate agents would tell people, buy the house, market's going to go up. If you can't make your payment, you can always sell it and make a nice profit. So, went from a crazy time to a point where now, geez, most people can't get loans.
Well, it's a little scary. And on top of that, of course, we've just had a general collapse in the real estate market.
Yeah. And really, it had to come when you're lending to people that, totally artificial, inflated incomes. What's going to happen when they figure out, geez, I really can't make this payment, and they walk away from the house? That's what we're in right now, and there's probably more to come. There were a number of these. They called them option arms, and they were the 1% loans that were originated, and they're getting to the point now where they're reaching their first adjustment period, and they're going to have some massive payment adjustments that people are going to have to deal with, and they just won't be able to make the payments, and so there's going to be another, segment they're going to have to walk away from their home probably.
So the way that those loans, as I recall, were set up was that they were paying almost like 1% interest.
Yeah.
For some sort of a teaser period, maybe 3 years, and then suddenly they become fully amortized loans and at a market interest.
Yeah, yeah. Typically, they had a 5-year period where it was an artificial interest. They were deferring their interest. It was just being added to the principal.
Yeah.
Then after 5 years, it becomes a 25-year amortizing loan at the market rate and plus an index. So typically, they're adjusting to a 7.5, even 8% interest rate, which is way out of the market right now. Wow. So these poor folks, they just won't be able to make it.
So they may be having a mortgage payment going from like $800 a month to $2,400 a month or something like that.
Exactly.
So and on top of that, I mean, we've got this sort of a spiral that's happening where or a vicious cycle that people were using their homes as a piggy bank. They could get an equity loan. They were borrowing against that to make consumer purchases, vacations, what have you. Suddenly, the value of the house drops down. The bank's calling these loans, and then people stop the borrowing. General economy starts to contract. People are getting laid off. They can't make their mortgage payments. More contraction.
Exactly.
And so it just was sort of feeding on itself.
You're exactly right. I think a lot of the boom of this decade has been directly from people using their house like an ATM. And you could buy a Lexus and just use your equity line, and that's all gone away now.
Wow.
So even what you would say your grade A credit-worthy buyers or owners, they've had their equity lines frozen, so they can't use them. So it's just, there really is a credit crunch out there, and it's affecting everybody.
Okay. All right. So let's talk a little bit. How has the mortgage lending picture changed from 2 years ago to today? So what did it look like 2 years ago, as from the lender's standpoint, and what was happening, and now what does that picture look like?
It's completely turned around. I mean, it's gone from where you could pretty much get anybody financing on a property to where you can't get, many people just cannot qualify for a loan no matter what. So it's it's just kind of a natural reaction to the state of the market. But today, we need full income documentation. So that means we've got to usually have 2 years of taxes, a current pay stub, W-2s, current bank statements, and we've had lenders verify employment up to 3 or 4 times during the process of a loan. And we say, well, geez, can't you just do it once? And they're so gun-shy and giddy that they're just taking every measure they can to make sure that these loans are going to perform. So it is quite difficult. You, as a CPA, know that, boy, the financials that you have to provide now are substantially more than you had to do it 2 years ago. A lot of different things now that are required that we just didn't have to have 2 years ago. And it's probably for the good, although, like anything else, there's some things where people get carried away and they really don't help.
Yeah. I think another thing is it wasn't so long ago, at least for my client base, I guess I'm kind of fortunate, but I had a number of people that were buying homes, with values over $1 million. And for them to get $1 million loan, it wasn't a big deal.
Yeah.
And they could get pretty good interest rates. Suddenly, these larger loans become very hard to get funded.
It's a huge deal, yeah. We hear from lenders that this year is going to be the year of the jumbo, and we've been hearing that all year long.
Yeah.
It just hasn't happened yet, and it won't happen until there's a market for securitization of jumbo loans. That's a huge issue because, here in California, we have so many people that are in high-value properties, and they have $1 million loans or $800,000 loans or a $700,000 first and a $300,000 second or what have you. So and we just have not been able to get competitively priced jumbo loans. There are some jumbo loans out there, but the qualifications are very, very strict, and banks just don't want to do it unless they have a really good feel for it, if they have money that they want to invest in it. So it's just been really tough for jumbo. So we hope that loosens up, but I don't see it happening real soon.
Yeah. And